afternoon, everyone. Good morning, wherever you are. I'm so happy that so many of you are joining us for this very important, I would say, opportunity to highlight investing in water and sanitation. We have some excellent speakers today, and I'm very happy to present to you the people from Roots of Impact, Incovin, and Water.org, from which you will hear in a second. I'm about to kick off to give you some background on, the water and sanitation sector, and also what is the role of Aqua for All. The agenda for today is that we're going to talk about the challenges to achieve SDG 6. We're going to talk about impact investing in WASH. We're talking about a little bit of background on the water and sanitation sector to give you a better understanding of where we stand and what is needed. I'll just highlight a few words on Aqua for All and the possibilities for people to and organizations to collaborate with us. And then I would say we're going to move to the most important part of the presentations, and these are the examples of the other speakers that you're going to see. So my name is Josien Sluis. I'm the Managing Director of Aqua for All. And let us talk about what challenges there are in reaching SDG 6. Mostly, I would say that there's a huge service gap. In order for us to achieve SDG 6 goals, as we have defined them, we need to overcome a lot. There are 4.5 billion people that do not have access to sanitation services, and 2.1 billion people lack access to safe drinking water. This is huge. If you compare it, most of the people that are watching this presentation have been working for many years in the financial inclusion sector. And if you compare facts and figures there, then you see that we've always been talking about just over 1 billion people that did not have access to financial services. So this does not only have an effect on the well-being of people, of course, it also has huge economic effects. We talk about losses up to 7% of GDP, and think about the fact that, we need to pay huge bills for people that have waterborne diseases and end up in hospitals. So it is a very, very serious challenge that is ahead of us. So how are we going to solve it, and what are there impossibilities that we can work on this gap? I think the biggest problem of all, and that is highlighted on the next slide, is that there is a financial gap. Currently, there is a lack of access to funding. The public funding that is available for this sector is less than 5 billion on an annual basis, whereas if we want to achieve the goals for SDG 6, we need 114 billion. So you can imagine that, in my opinion, there is only one way to go, and that is that we're going to make sure that we're going to catalyze private investments into the sector. And there is a huge need, and we're going to talk about how are we going to do this. I think that de-risking is one of the solutions. So if we're going to go to the next slide, then you see that the GIN did some research to find out if impact investors at all have an interest in investing in water and sanitation solutions. And if we talk about WASH, water and sanitation and hygiene, I'm not talking about the big utilities. I'm looking at the more down level kind of opportunities that are out there. And indeed, if you look at the list here, and I noticed that it's very small, but the WASH as an asset class is put forth on the list of impact investors. And so I understand it because, of course, water is something that we all understand to be very, very important. And there are opportunities, although it still remains a challenge to get everything in place. And to give you a little bit of background of, what are possibilities, we're going to move to the next slide. I just wanted to highlight a few examples. Water.org, for example, is working on their credit impact program. And of course, Darren is going to tell us a lot more interesting stuff on the work of water.org. But just as an idea for you active in the financial inclusion sector, the capital that is mobilized in India when you look at financial inclusion is over 500 million euros. The average loan size of financial institutions on lending to households or SMEs, but mostly households in this case, is 178 euros. So what is it that they use it for? In India, it's mostly for sanitation purposes, constructing toilets in your homes, etc. There's also another example that the Finnish Mondial program has been working on. This is MFI called Cashpoor. We raised 2.8 million euros also for on-lending to water and sanitation solutions. And I'm going to go into a little bit more detail on the Citibank WASH portfolio that both Finnish Mondial as well as Aqua are supporting. You see that repayment rates are over 96%, and so that allows us to see it as a valuable kind of asset class to invest in. We're going to move to the next slide. Just to give you a little bit of background of, if we talk about the water and sanitation sector, what is it that we talk about? So if you think about the water value chain and then you talk about private water enterprises, we're not talking about the big utilities because they require huge infrastructural kind of investments that quite often are dealt with World Bank, etc. But if you take Kenya as an example, I never realized before I started to work on investing in water that 70% of the water is supplied through private operators. And that means that only the smaller part is being serviced by the utilities. And so what is it then? What kind of SMEs are active in the water sector? So if you have water sources, you need to pump it. So there are SMEs active in providing equipment. Water needs to be treated. So also that requires technology. You also need to store it. You need to distribute the water. You need to sell it through your kiosk or any kind of other delivery system. And when you have it in your home, you quite often need to either boil it or preferably use water filters. So there's a whole range of SMEs active in the water value chain. If we go to the next slides, what we did is we asked Citibank to give an overview of the water and sanitation enterprises that are currently in their portfolios. These are the SMEs that are targeting very specific sectors. They are active as a safe water enterprise, they provide hardware, they work in agribusiness or, for example, do delivery to hotels and restaurants. So it's a wide variety of SMEs active in this sector. What we did with Citibank is we said, especially in COVID times, it's extremely important that you're able to on-lend to these kind of entrepreneurs because water needs to be accessible 24/7. And if you do not have access to water or that you need to enlarge your storage capacity and all these kind of things, people need funding in order for them to continue their services. A very different kind of enterprise, a bigger one, is an example of a safe water prize in East Africa. It's on the next slide. It's been founded in 2012 already. They currently have almost 100,000 clients that they service through different kind of outreach. So either they do home delivery or they sell their water through exclusive resellers. They bottle the water and they use a franchise model because quite often what you see is that for SMEs active in this sector, it's difficult with the very small margins on water and the relatively high upfront kind of investments that are required to get to that break-even level. And this is where we, through our grants and through different kind of financial models, blended finance models, we support these enterprises to get through that valley of death and become investable. If you want to learn more details, I'll take that out of this presentation, and we're always there to give you more details on this. Then Aqua for All. Who are we? We are a not-for-profit organization. We have long-term expertise in the water and sanitation field. And we receive a grant from our Ministry of Foreign Affairs in the Netherlands to work on our Making Water Count program. In the next slide, you see that we've managed over 140 million euros in funds already. We worked in many countries and supported over 200 organizations. So then how do we offer possibilities and opportunities for collaboration? I already told you about our Making Water Count program. It's a 40 million euro program for 5 years that we are able to allocate to different kind of trajectories in the market. And we do that through innovation, which you see the first pillar, scaling of enterprises represented in the second pillar, and both of them are focused on business development, either to get ideas to proof of concept and then to become ready for investment. And then only recently, since let's say over a year, we are closely working with investors, because what I've seen also in my previous work is that it's quite difficult to bridge the gap from what NGOs, not-for-profit, foundations, governments even are doing in the market to make sure that it really matches what investors need out there in the market. And quite often I've seen that we speak different languages, and so what we do now is we work closer with investors to make sure that we understand what they need, to understand how they look at potential investments in the sector, so that Aqua for All then is able to scale, to work on better scaling programs. One of the examples that you see here along the scaling pathway is our initiative that we do together with Roots of Impact. Bjorn will going to tell you more about it. It's called our Social Impact Incentives model. I just highlighted to you already that quite a number of companies have difficulties in break even because of margins and reaching out to even lower segments in the market. And through this model, we assist them to grow and access different kind of capital. On the other hand, you also see that, we've already talked about financial institutions building up their wash portfolios. On the demand side, that's extremely important. And this is what water.org has been doing for many, many years. Currently, we're working jointly, and of course, water.org is in the lead, on the water access, on the Global Credit Enhancement Facility that supports financial institutions to continue to on-lend and to be even, quicker in doing this because they are guaranteed. And with Incofin and Danone, we're working on the Water Access Acceleration Fund. It's a fund that is established in order to direct invest in water-related SMEs. And Dina Pons will tell us more about it. I think that these kind of different initiatives that Aqua for All supports through either providing, next slide is perfect, through delivery of technical assistance on SME level, or for investors to do the design and preparation grants, to work on de-risking solutions. On the right-hand side, you see our catalytic instruments. We provide you with de-risking solutions, either through providing first loss or guarantees, or we work with different companies on result-based financing, either through impact incentives, again, this is Roots of Impact, and carbon credits. So you, as impact investors or consultants in financial inclusion or impact investing, what is it that you can do? On the left-hand side of the slide, you could either provide liquidity to MFIs or local banks. You could invest in funds, as the one that either water.org is going to present or Incofin, or you could choose to directly invest in WASH SMEs. And then I'm going to finish here because I think that the examples that the other three of my colleagues are going to present give you a much better insight. I want to thank you for your attention so far. And Bjorn, can I give you the floor now?
Thanks a lot, Josine. Hi, my name is Bjorn. I'm the founder and CEO at Roots of Impact, and I would actually like to give you some insights about the model we are using in the wash sector now for bridging this gap. Josine showed you this early stage financing gap, in particular for innovative wash enterprises. So if you look at the first slide, there you see that the typical wash enterprise here represented as the small hero is actually not yet there to be on the efficiency frontier for investors. So they actually lacking either profitability or are simply too risky to be considered by traditional investors, even impact investors, to be an investment target. And there are two ways actually to change this. One way is actually moving them down the risk line and reduce the risk of this transaction. And you will see how this works later with Darren's presentation. And there is another opportunity just to increase the profitability and enhance the return for the investors so that they can go up to this so-called efficient investment frontier. So if you go to the next slide, then you just see one difference, that there is already, sorry, just one back, because it's actually just one change, that you see that carbon credits are already used right now exactly for this. They are used to improve the bottom line of these wash enterprises in order to get them more investable. And now you can go to the next slide. We at Roots of Impact, in partnership with Aqua for All, we were thinking about, well, what if we would extend the scope? What if the entrepreneurs who actually generate much more value than reducing emissions would actually be paid for all the value they create for their customers and their communities? So on the next slide, we asked ourselves the question, how could we actually reward these enterprises for the social impact they create? And this social impact, the outcomes of these businesses are broad. So they have so many different positive impacts they generate, be it in health outcomes, be it lower spendings on clean drinking water, etc., etc. So they are more than just carbon emissions. However, we can actually use the same model like carbon finance also for other SDGs. And on the next slide, you see how actually social impact incentives work from the perspective of the wash entrepreneurs. So let's assume they are not yet there in terms of profitability. And these outcomes-based premium payments actually help them to, let's say, get more profitable, get more attractive for investors, and then they just improve their profitability to a point where investors get interested. And this is actually the whole trick. It's quite a straightforward agreement between an outcome payer and an impact enterprise in the wash sector. On the next slide, you see how this all fits together. On the left-hand side, you have Aqua for All, our partner here, as an outcome payer, committing to pay premiums to the enterprise based on measured and verified outcomes. And these outcomes can be everything, right? It's tailor-made, it's bottom-up developed with the enterprise. It is actually a a tailor-made transaction. And in this contract, we actually promise the enterprise to pay for future outcomes over a course of 2, 3, 4 years. We can structure this as we like. These enterprises then can raise investment at the market, typically with impact investors, right? So it's a separate contract between the investor and the enterprise, with us as a backing, with this commitment that we will pay them for the value they create in the future. Our contract technically closes as soon as the enterprise has successfully raised investment. On the next slide, you can see that we actually developed this model I think we started in 2016. Next slide, please. We started in 2016 in healthcare in Latin America, and since then we did several transactions. Here you see 6 only in Latin America. There are 10 others who are right now in structuring, so it's not an experiment anymore, it's kind of proof of concept. And from these enterprises, I just want to show you one example, in particular the results of the intervention. These are the results of our social impact incentive for Clínicas del Azúcar, which is actually a social enterprise in Mexico, active in diabetes treatment. So a private provider of diabetes care. And they actually introduced a model for the bottom of the pyramid Mexicans to make it affordable, to make, let's say, diabetes treatment as affordable as possible. And they actually offer a model and a price which is 60% below the competitors. So really accessible and affordable. However, we were interested actually in push them further in terms of reaching more BOP clients from the bottom of the pyramid, and also improving their outcomes in terms of health, the treatment, the health outcomes. And here on the left side, you actually see how Clínicas del Azúcar improved their proportion of BOP clients. This was one of the metrics we used to pay them premiums for. And it is expected that they will have 10,000 additional BOP clients, which was actually catalyzed by the social impact incentive transaction. And these outcomes are independently verified, which is of course important because we are paying for this. On the right side, you see that, as I said, this is a blended finance instrument. So it is able to mobilize investment. And Clínicas del Azúcar, we committed to pay $275K in social impact incentives over 3 years. And they attracted in the first round 1.5 million in equity as a means to scale. And then just a year later, they did a financing round with IDB and IFC of 6 million in debt. And this is just an example, and very important also to understand that we are always looking at additional effects and not, let's say, focusing on things that happen anyway. And the next slide, please. I told you that we are partnering with Aqua for All. This is the first time that we fully focus on the wash sector with this model in order to actually bridge this early stage financing gap. On the right side, you see a few of our initial insights. So we cannot yet present you the companies we are going to support. We are in the middle of a very exciting selection process, and we saw so great innovations in the wash space. And and in particular, the potential to actually raise investment and scale is immense, in particular in the water in the water sector. Sanitation, of course, is a harder play, but there we also think about providing much more capacity building for these companies to get them investment ready into the point when they also would qualify for social impact incentives. Last but not least, we also learned, and of course, this is quite obvious because these enterprises do generate public goods, that there's a big role to be played by the public actors, by contracting these companies and also creating regulations that are beneficial for them. So far about social impact incentives, happy to hand over to Dina.
Thank you very much, Björn. Great. Good afternoon, everyone. So indeed, the purpose of my presentation is to shed the light on another type of contribution to building the investment readiness of the water sector by highlighting to you the more recent initiative that Ecofin is spearheading along with Danone in accelerating access to safe and affordable drinking water in Asia and Africa. So again, my name is Dina Pons. I'm a partner at Ecofin Investment Management. I'm also the co-regional director for all our operations in Asia. So I'm calling you today from Phnom Penh, Cambodia, and very happy again to have the opportunity of this conversation. Next slide, please. First, I would like, in a nutshell, to give you a little insight on Ecofin. I think given that we are in the financial inclusion community, likely you might have heard our name. In summary, we are an international impact investor. We've been operating for almost 2 decades. We are licensed and regulated entity since we're headquartered in Europe. And we are currently managing 1 billion euros of assets under our management. We deploy this money through 3 types of instruments: equity investment, debt investment, as well as technical assistance. And we do that thanks to the loyal and long-term support of a very diversified base of investors. You can see indeed at the bottom of this slide that we've been typically working with a very diverse type of investors, from development financial institutions, so public money, but also private institutional investors, pension funds, banks, and insurance companies, as well as high net worth individuals, or just people with a bit of savings who want to do responsible investments. Our key kind of 3 pillars have traditionally been financial inclusion, food, nutrition, and agriculture, and more recently water. And the purpose of this conversation is for me to give you a bit more highlights on the way that we're approaching the water sector. Next slide, please. As I mentioned, recently, Ecofin and Danone have been partnering to again invest in social enterprises that aim to improve access to safe and affordable drinking water. We see this partnership as quite exciting because it's basically putting together 2 different animals. On one hand, you have Danone, which is a multinational corporation. On the other hand, you have Ecofin, which is an international impact investor. For everybody's knowledge, Danone, since 2007, has set up an impact investment arm, which is called Danone Communities, and which is mostly funded by employees' money. And the aim of this facility was to deploy incubating patient capital in businesses in emerging markets that were promoting good nutrition and safe drinking water. So after 13 years of investing in this sector, after 13 years of pilot testing what worked, what didn't work, of putting entrepreneurs in the same room to understand the key takeaways of what were the challenges, how they could exchange on best practices, they came to the conclusion that the sector was now maybe very likely investment ready, nascently investment ready, but at least had the features now of being able to attract new type of investment of investors that will aim to not incubate the sector anymore, but rather to accelerate it. So it is in this context, in 2020, that Danone chose Ecofin to be their impact asset manager, to manage a fund that they will sponsor, and which again will finance not small starting businesses, but very much proven businesses that are aiming to accelerate drinking water access in emerging markets. And this is, again, the journey that we are starting with Danone. Next slide, please. I would like, for the sake of, again, our conversation, to pause and give you 3 key takeaways on this collaboration that maybe could, inspire other stakeholders when they engage in that type of collaboration. I think if we, take a step back and look at this nascent partnership with Danone, I would say that the 3 things indeed that come to mind in terms of keeping in mind. The first one is that it's extremely important, and we should never underestimate the importance of aligning social missions. In the case of Incofin, our DNA has always been that we were created with the idea to want to do meaningful impact investment. That's the very first thing and the only thing we're actually doing. In the case of Danone, I would say that in addition to Danone Communities, which by essence, by the incubating patient capital nature, is an impact investor, Danone as a company is putting in place for a long time a number of very interesting socially innovative initiatives in the space of wanting to reduce their plastic emission, in the space of wanting to make sure that they don't deplete natural resources, but also in the French context in wanting to apply to be one of the first listed companies to avail to a social business status, which basically would mean that you would incorporate in the article of association of the company that the aim of the company is not to need to answer the fiduciary duties of the shareholders, but also to take into account the interest of other stakeholders such as employees, the societies, the environment. And I think in this regard, being such a big economic player in the European Union, this is quite a very brave move. The second one is complementary expertise. Again, at Incofin, we know how to do equity impact investment in emerging markets, and we're benefiting in this learning journey with Danone on how, again, the operational conclusion that they're drawing on what works and what doesn't in the safe drinking space. And I think that complementary approach allows us to, never step on each other's toes and to always, try to learn from each other as we bring and design this facility together. Finally, I think local presence is extremely important. I think we would never be able to claim that our investment strategy is relevant if we don't listen to what's happening in the field. In the case of Danone Communities, they have 15 investments in 15 different countries. So being able to gather a lot of information from various environments, from regulatory context to, of course, country risks, to different type of entrepreneurship. So I think this is extremely valuable. While on our side, we bring the presence and expertise of our 5 regional offices. Next slide, please. The fund, the facility that we are structuring together is, to me, very much the essence of what we call impact investments, because it's aiming to not only reach financial objective, but also impact objective. On the financial side, again, in line with what has been said by Yosin and Bjorn, we want to demonstrate the financial viability of the water sector. We want, through our first kind of Series B investment, being able to catalyze growth in the water sector by attracting co-investors, potentially Series C's equity investors, but also private debt providers. And we want, in the spirit of today's conversation, to contribute to the building of a like-minded water business ecosystem where we can share our knowledge and our key takeaways. On the impact side, I think it goes without saying that, of course, we want to aim to contribute to SDG 6. We want to aim to track the what, how many billions of liters of safely managed water, of course, our businesses will contribute to, but importantly also the who. What is the type of socioeconomic profiles of the customers that will avail from this now safe drinking water, as well as the how. We don't want to be providing any type of water. We want to be providing an affordable water. I think this is also extremely important. As Yosin mentioned, beyond SDG 6, I think investing in the water sector also contributes to economic growth. And in this regard, the franchises business models that we aim to back, we hope to be able to track the additional income generated at the level of their local communities, also the additional job creation, of course. And then I think there's a whole universe of climate-related indicators that we want to make sure that we track by promoting, the production of water in the most efficient way, by looking at a percentage of non-revenue water, but also by making sure that we abide by the highest standards around, replenishing natural reserves, not depleting any natural reserves, being able also to promote green finance and carbon credit in this regard is something to explore, as Bjorn was mentioning, trying to reduce CO2 emissions, as well, of course, as promoting a reduction of use of plastic. Next slide, please. So in a nutshell, what we are basically talking about is a facility that will provide equity or quasi-equity investments, as well as technical assistance. We foresee that it's extremely important to come with a complete package that not only offers financing, but also recognize, as we've been discussing, the recent nature of the investment readiness of the sector, and therefore that we support them on the required technical assistance and capacity building support, fine-tuned to the needs of each investee. By doing this, what will happen? We aim to become significant minority shareholders, and we think that that's typically what we call the role of a co-pilot, where we want to sit at the board of directors with our companies. We want to understand and help them solve issues together. We want to aim to do that by investing ticket size between 3 to 5 million euro. We recognize these are quite decent amounts, and this is why we anticipate to be doing this by disbursing money in tranches in order to make sure that we don't over dilute promoters and respect the business model that they have created and keep them with the right authority needed for them to run their business. We want to do it in a patient manner and aim through this fund that has a 10-year life to invest through typical tenure of 5 to 7 years at the level of the investee itself. And from a geography perspective, we aim to do that basically by splitting our investment through Asia and Africa. Again, to precise a little bit what we're talking about when we say what type of water businesses you are investing in, coming back to Yassine, what Yassine's saying, we're looking at not the big infrastructure projects, but very much locally rooted small water businesses that are of three types. First is the asset light type, which is what we call the safe water enterprise, and that indeed typically would offer a water solution in the case, for instance, of 20 gallons a liter that could be provided to people who are typically of one of the highest poverty profile because they don't necessarily have a fixed residence, so they cannot even think of having tap water at home. That's one key type of businesses. The second one is water technology companies. And again, we're not talking about any type of water technology companies, but one that can prove to have a business model that is A, tested, B, a business model that is affordable and scalable in an emerging market context, and C, to be businesses that have a real intent to work with bottom of the pyramid population. I think this is very important to note. And finally, we aim to also support a small grid type of decentralized piping infrastructure. So that could be, for instance, water stations that are being aggregated in rural areas, aggregated in order to enhance the way that the water is provided, to reduce non-revenue waters, and to make sure that when the water reaches the household, it is indeed drinkable. Next slide, please. So coming back to the topic of this conversation, which is to say, if we are looking at a recently relatively investment ready sector, and if we recognize that not a lot of investors have kind of looked at that sector or have felt comfortable about it, then we think that looking at blended capital structure is likely a very interesting way to attract a diverse set of LPs. So here is an example of how you could consider structure and impact first private equity fund. If we start from the bottom, I think what's quite innovative and one of kind of innovative solutions that are out there is to first of all say, well, if it's an impact first type of sector, why don't we look at setting up impact performance incentives? And when I say that, it means the incentive towards us, the asset manager, meaning that you can reward us not only by telling us to reach a certain financial return, but by very much aiming to reach a certain number of list of key impact indicators. So very much in line with the previous initiative described by Bjorn. Second, the first type of class of shares that is structured in this type of fund is the shares that is provided by, again, us, the asset manager. I think it's typically very key for investor to feel comfortable that the asset manager is taking a risk along with them, and that we committed to this fund, that it will be a key strategic project within the Incofin's investment strategy, for instance. And then come two interesting type of shares providers, the B shares and the A shares. The B shares is the one that is the most innovative, in the sense that they are the ones that could contemplate or providing what we call the first loss tranche. First loss tranche is basically a tranche of capital that you bring and you say, in case the fund make losses, use my money to absorb it in order to protect and to de-risk the money of that could have been brought by other type of investors that have a different type of risk appetite. We feel that there is a whole universe of potential first loss providers. It meets very well the type of agenda of, for instance, a sponsor investor. Sponsor investor really wants the fund to be a success, and in this regard, for them, providing that sort of money is aiming to be catalyzing. Foundations, of course, can also be another type of first loss tranche providers, government entities, as well as DFIs in the specific impact first or social innovation envelope that some of them have in the organizational chart. And finally, why are we doing all this? We're doing all this to be able to attract A-share providers. The A-share providers might be more traditional type of investors. They might be corporates, they might be development financial institutions, but they are only able to invest in growth capital type of fund mandates. And what do we promise to these ones? We promise them a certain return, again, knowing that there is a first loss provider in the structure of the fund. But what we do to them is that we don't promise them the moon. We are very clear with them that it's not traditional private equity financial return that should be expected here. And here, in the case of the water sector, given the type of businesses that I've mentioned to you, I think it's safe to say that we will aim to reach a high single-digit type of return. My last slide, please. I'd like to share just a few summary remarks by saying that we're quite convinced that first loss tranche lowers the perceived downside risk on the asset side. It's a very, again, innovative and useful tool that we think should be explored out there, because again, the water sector is quite recent. Its investment readiness features are quite recently being exposed and understood. So we need to kind of break that prejudice that people have in their mind that this sector is not investable. In this context, the first loss tranche allows to lower the perceived downside risk for more conventional shareholders and help them to dare to take the risk. Second, the type of facility that we're structuring is again being very transparent with the fact that impact is at the heart of the investment strategy, and that the type of return provided, again, will not be conventional PE, but will still be there. High single digits in the context we are in is actually not a bad return. And it's also based on the fact that technical assistance is a very important tool in addition to the equity that will be provided. Finally, from a fundraising perspective, I think maybe a few key takeaways. I think we see that there is a whole universe of grant providers out there that maybe have always thought that their money had to be used in the traditional technical assistance way, put into a facility where it's grant money. I think we can have a whole conversation on to what extent the grant providers could be first loss tranche providers, because at the end, the catalyzing effect of a 1 million euro put for a first loss that can then attract many millions other euros of A shares that would say, okay, there's this first tranche loss, it changes the risk profile of this fund, and I might consider, is very different than, of course, putting 1 million in a technical assistance facility where 1 million only will be rightly spent to provide capacity building. So I think the two options are not mutually exclusive, but I think in the grant providers community, there's possibly something that could be further explained. Of course, we're entering into a whole conversation on fund structuring, which is typically something that maybe grant providers are not always so familiar with. So hopefully this type of conversation can start paving the way to that type of awareness. Two last points, I think COVID-19...
You please finalize, because I really want to give Darren the floor and for people to ask.
Yes, of course.
Yeah.
Then just to say that in conclusion, and maybe giving the last slides, that COVID-19 has proven that water access is an even more pressing issue, where people are in need of higher hygiene, are in need of maintaining their immune systems. And interestingly enough, we see that water businesses are proving that they have a higher financial resilience in this context. So further pushing us to accelerate our efforts to build the water sector. Thank you so much for your attention. And Darren, I'll give you the floor.
Great. Thank you very much, Dina. And thank you, Josian, for giving water.org this opportunity to share our experience about the Global Credit Enhancement Facility. So my name is Darren Mayo. I am the Global Investors Advisor at water.org. And really just before I start, I wanted to acknowledge there is a lot of information on the slides. Hopefully, if you take away two key things from this presentation, it's that one, water.org is focused on mobilizing capital at scale by catalyzing new WASH transactions. And two, establishing the GSEF has given the organization invaluable experience to achieving this objective. Next slide, please. For those that are not familiar with us, water.org is an international nonprofit organization that has been working to solve the water crisis for the past 30 years. Through our work, we've been able to help over 31 million people gain access to clean water and sanitation by mobilizing over $2.4 billion into the sector. Now, we've accomplished this objective by working with over 160 partners in 13 countries in improving access to WASH financing for households, SMEs, and water utilities. Next slide, please. Now, global investors, the practice which I sit in, is somewhat unique in the organization as we are solely focused on catalyzing new WASH financial transactions to mobilize capital at scale. You know, as Josie had mentioned from Aqua earlier, the WASH sector currently lags behind most other SDGs in terms of attracting both development and blended financing. From our perspective, a primary reason for this financing gap is that significant upstream work is required to both identify and structure new WASH transactions. And water.org believes that as a nonprofit leader within the sector, we are in a unique position to directly address this market issue by undertaking the upstream work through the global investors practice. Next slide, please. Now, before I go into detail about GSEF, I just wanted to share with everyone some of the other transactions that Global Investor has been developing over the past year. These transactions were identified based on the programmatic work being done by our field teams in the country. And as you can see, these transactions support a range of stakeholders, interventions, and investment opportunities within the sector. For each transaction, Global Investors is partnering with external impact advisory firms to help us develop these concepts. And we welcome working with other firms to either further these transactions or to develop new ones as opportunity arise. Next slide, please. Now, the Global Credit Enhancement Facility represents the first transaction structured by water.org. The facility offers a partial loan guarantee to local commercial banks to incentivize them to grow their existing WASH lending portfolios. Now, we intentionally targeted commercial banks due to the greater scale of operations and the amount of existing capital on their balance sheet, because we really thought if we could unlock this type of capital, we should see a significant scaling of WASH lending in the countries where we offer these programs. Now, based on our programmatic experience in working with these commercial banks, we knew that these financial institutions often had limited experience with WASH lending and viewed this sector as being more risky than others. As such, the GSEF was designed specifically to address this perception by offering participating institutions a partial first loss guarantee program. Next slide. In terms of how the GSEF is structured, it actually adopts many of the same characteristics of existing partial guarantee programs on the market. For each commercial bank, we first negotiate the overall size of the WASH loan portfolio to be developed by the participating financial institution in the program. Next slide. Next, once the overall size of the lending portfolio has been determined, we then negotiate with each commercial bank the overall percentage of the WASH lending portfolio to be covered by the GSEF first loss guarantee. Now, this percentage will vary country by country based on local market conditions, as really what is demanded by the local commercial banks during the negotiations. Next slide. Once the percentage of the overall WASH portfolio has been determined, which will be covered by the GSEF, we next negotiate with the commercial banks the actual percentage of the first loss that will be borne by the local financial institution and what will be reimbursed by the GSEF in the event of losses. And we really do this because we still want banks to have skin in the game by accepting some of the first losses that they may experience within their wash lending portfolio. And again, this percentage will vary by country based on local market conditions. Now, aside from these two factors, during the negotiations with the banks, we also discussed with them, what is the desired duration, the fees, as well as we place a limit on the SMEs that can be included in the overall portfolio. And that is really driven by kind of our capital providers, which, I'll quickly explain kind of on this slide. So everything I've described, really follows a traditional partial loss guarantee structure. Where Water.org really focused our efforts, in partnership with Aqua for All, is really figuring out how to attract the private capital to fund the facility. Very similar to what Dina was mentioning, in terms of how they structured their fund. So with the support of Aqua for All, we were able to develop a blended finance structure that helped us secure a $50 million commitment from IFC to launch this program globally. Under this structure, Water.org raises donor capital from our network to absorb all of GSEF first losses. Now, any capital remaining within this tranche at the end of the facility will be returned to the donors with the possibility of realizing a nominal upside if the guarantee is not fully called on by the participating commercial banks. Now, this subordinated tranche was extremely important because it provided sufficient reserves for IFC to provide commercially priced second loss guarantee capital. From Water.org's perspective, this commitment represents a significant milestone, as it was the first time that IFC has actually ventured into the wash lending space. Our hope is that as IFC gains more exposure and experience within the sector through this facility, their requirements for the donor capital will reduce over time until a wash guarantee simply becomes another commercially available product offered by IFC. At really which point the GSEF will no longer be needed. If you move on to the next slide. Now, we were actually set to launch GSEF in India of Q2 of last year, but I'm sure, as all you know, kind of COVID played, significantly delayed those plans. So now we're expected to launch the facility sometime in Q2 of 2021. Now, I won't go into every detail about how we've structured the initial facility, but you can see on the left-hand side of this slide really kind of the key terms of the India country facility. In regards to the participants, we've actually already signed term sheets with 4 Indian commercial banks to disperse $125 million in new wash loans over a 3-year period. To support this facility, Water.org, we've already secured $7.8 million in donor capital commitments, with IFC providing the remaining $5.25 million in second loss guarantee capital. Overall, we expect this facility to result in 625,000 new wash loans dispersed that will ultimately result in 3 million people gaining access to clean water and sanitation through this program. Next slide. And although we are planning to launch the GSEF in India first, our intention, as I mentioned earlier, is to really roll out this program globally in partnership with Aqua for All and IFC. And while the initial expansion will focus on countries where Water.org has existing operations, we are always happy to talk with others if they believe this type of program can be applied in other markets, with really the main criteria for how we assess whether a market is appropriate for the GSEF really listed on the left-hand side. Just a last slide. And with that, I just wanted to close my presentation by saying that Water.org truly believes that there are a number of transaction opportunities that can mobilize capital at scale into the wash sector, and we look forward to working with in really making them reality, similar to what we have done on the GSEF. Thank you very much.
Thank you so much, Björn and Dina and Darren, for your very insightful presentations. We have 5 minutes left for the audience to start asking questions. Are there any questions? And if so, please please do reach out to us. And as I've been highlighting before, at the very beginning of the session, there will be a next session starting in 5 minutes, also to discuss more detailed on, the role of e-MFP in promoting with their members how we can promote investments in WASH. And of course, if there are ideas or needs to directly contact either one of the presenters today, please just simply let us know, either Gabrielle of e-MFP or ourselves at Aqua for All, so that we can connect you and make sure that all of your questions are addressed. I don't see any questions coming up, even though maybe I'm going to ask the ones that are active behind the scenes, Gabriela or Alvaro. Do you see any questions out of the audience coming in? Otherwise, I'm going to think about closing this session. Let me see, is there's a chat? So the host is telling us that at this very moment, there are no questions. And Gabrielle also, so that I think that we had very clear presentations. Thanks again, Dina, Darren, and Bjorn. We're going to see a few of you, I think, also in the next session. Let's see how we can contribute. And I'm very grateful for everyone who listened in. I'm looking forward to take this topic towards the agenda of e-MFP and continue to work on this. Thanks a lot. Thank you all.
Thanks from my side as well. Bye-bye.
Bye-bye.
Take